Okay, so before you even start looking at houses, shopping for houses, make sure you get pre-approved. Now, pre-approved simply means that a mortgage broker has assessed your financial picture, so your credit score, like we talked about, your debt to income ratio, how much you make and earn, what assets you hold in the form of liquid investments, so cash, mutual funds, money market funds. They also may consider your 401k, since you can tap into that for when you're buying a property. So they're going to look at that entire financial picture and say, okay, based on this information, how much house do we think you can afford? So they're going to give you a range, and that range is going to be dependent on a couple of things. It's going to depend on where the house is located, because they do look at that specific market to say, okay, how much does, the average home cost? So that's going to go into how much they actually loan you. They're going to look at the type of house. Is it a single family house? Is it a duplex? Is it a triplex? Is it a fourplex? And then they're, of course, going to, again, look at your financial picture and say, based on like these things, here's how much we're comfortable with saying you can afford. So they're going to give you a minimum amount and they're going to give you a max range. Hear me, and hear me really good when I say this. Do not shop for a property at the highest end of your range. I will repeat, do not shop for the houses or the properties that are at the very tippy top of your range. I say that because oftentimes a lender or financial institution, they're going to give you a overly optimistic picture of what you can actually afford, because they're using your gross wages a lot of times to determine how much house do we think this person can afford. Now, we all know when the federal government takes their share, if you live in a state where you pay state income taxes as well, you have to pay medical, you should be putting away for a 401k. What your take home is, which is the more important metric, the gross sounds nice, but the take home is what we live off of. Your take home earnings should be driving what you can actually afford. So what you should be doing is you should be taking your take home income to understand, okay, based on my take home, how much mortgage am I comfortable paying every single month? And when I say mortgage, not just the principal and the interest on your mortgage loan, I'm talking about your property insurance, because that is a requirement of the lender for you to have property insurance. And of course, your property tax, because that is another requirement of your lender. You have to be able to pay your property taxes on time, or else the government, so your county and maybe your city or state in some areas, they can actually seize your property or put a lien, I should say, on your property for failure to pay property taxes. So it is very important to look holistically at what you're going to have to pay just to keep your home. Now, if you're buying a single family home or other type of residence that has an HOA, you also need to consider that, because your HOA is also going to require you to pay them. And I believe they even may be able to put liens on your home should you not comply with the HOA's rules or stop paying them. So it's very, very important to compare your take-home pay to your overall holistic payment. Your holistic payment includes your principal and interest, aka your mortgage, your property insurance payments, your property taxes, and if it applies, your HOAs. So looking at that monthly payment compared to your monthly take home is how you should determine how much house you can actually afford. Not looking at your pre-approval letter to say, oh, the lender or bank told me I can afford $1 million home. Let me go shop for $1 million home. No, siree, Bob, because your take home might tell you you will be extremely financially stretched in $1 million home. So Zillow has a really cool feature where you can play around with how much your down payment is, because that's going to drive how much your mortgage is. And it will spit out all the different elements of your mortgage that I just mentioned. So your principal payment, your interest payment, your property tax, your insurance, your HOAs if they apply. And one thing I forgot to mention, your PMI. I'm gonna do a separate video on PMI because there's a lot to understand there. But it's very, very important that you understand your holistic mortgage payment, because it is not just principal and interest. And use that number to compare to your take-home pay to understand how much house you can actually afford. Now, realistically, you really don't want your mortgage, the holistic payment, to represent more than, I would say, 30 to 40% of your take-home pay. I know y'all are probably like, sis, how in the world am I going to make that happen with the way these housing prices are set up? And I would just say back to you, this is where you really have to challenge, is home ownership actually worth it? Is home ownership actually healthy for your overall financial goals? Because it may not be. And if that is the case, that is perfectly fine. I do not want you to fall into the trap of thinking owning a home has to happen by any means necessary, because that is not the attitude to have. I would hate for y'all to get into a home and then realize, oh my gosh, like I have to completely water down my lifestyle. I have to make so many different sacrifices just to pay for where I lay my head. Again, there's other strategies that will afford you the lifestyle that you want, that will allow you to live a very meaningful life, a very happy life, that may not include owning real estate. So remember, if you don't remember anything else from this video, please do not purchase at the highest end of your pre-approved range. All right, y'all, be blessed.